Have you ever heard someone say, that stock is super cheap, look at its PE value? Or maybe even more relevant right now, you've heard them say, all my life, tech stocks are so overvalued, just look at the PE ratios. Well, if you were hearing this and thinking, what the hell is the PE ratio? You are not alone. I know it certainly took me a fair few explanations until I fully understood what this PE ratio is, why it's so important, and what it actually means for not just stock valuations, but also the wider markets themselves. So today I'm going to break down what PE values actually are, what they mean for you as an investor, what's a good or a bad PE ratio, and how they interact with the rest of the market as well. Because most of us aren't going to need these PE ratios in our day-to-day investing unless you're some sort of trader. But most of us will need to understand what they mean for the wider market and therefore potentially for our broader investing portfolio too. Let's get into it. Hi there, my name is Zoe and welcome back to my channel. This is Words on Wealth. It's great to have you here, and this is where I break down all things investing, economics and finance to try and make it as simple as possible. Please do give me a like and subscribe if you're enjoying these, and as always, if you've got any comments on videos that you want to see in future, do just let me know. I'm all ears. So let's take it back to basics. What actually is a PE ratio? Well, PE stands for price to earnings ratio. And it's one of the oldest ratios used to try and assess stock values and stock prices as well. It's particularly used to try and find out if a company, and therefore their share price, is over or undervalued. Analysts will often quote the PE ratio when they're talking about whether something is cheap, expensive, or in total la land. The formula for calculating the PE ratio is pretty simple. It's very simply price per share divided by earnings per share. So in doing this calculation, what you're literally looking at is how much am I paying in relation to how much profit this company is actually making. So for example, if we see a PE ratio of 25, then it means that £25 is being spent for every pound of profit that's being made. Now I've used pounds there, but it could also be in whatever currency that company is denominated in. Dollars, euros, you get the idea. So it's a valuation tool to see how well a company is doing. Sometimes that earnings bit can be a little bit deceiving and it can make investors immediately think of the likes of dividends or how much earnings they as an investor are making. But actually, this is all about how much the company is making. And it's a useful tool to compare different companies and therefore different stocks within a similar industry. The PE ratio is quoted and used a lot because it's really simple, it's relatively quick to do, and it's very comparable. As I say, it has to usually be done within stocks in a similar sector, because often sectors have their own kind of PE ratios going on. And if you suddenly start comparing a PE ratio from, let's say, the tech sector to one that's in, for example, the utility sector, they are going to look wildly different. But if you compare like with like within the tech sector and within, let's say, the utility sector, then you'll often get a feel for how over or undervalued those companies are in terms of their share price versus how much earnings they're making. It's sometimes easier to compare it to the likes of house prices. If, let's say, houses in your area are worth around 3 times annual salary, be nice, but you see that that's a relative trend, it's pretty normal. If suddenly there's a bunch of houses that go up to being 12 times what the average salary is, then you might start to think something was up or something was fishy, or those houses at the very least need to have certainly something going for them to be 12 times worth as much if they're comparable to a house that looks pretty similar that's only worth 3 times as much, for example. So if we compare that to PE ratios within stocks, if you've got a PE ratio that's around £25, so that £1, as I said at the beginning is the example, and then suddenly one shoots in that's about £80, well, you want it to have a really good reason as to why this was the case. So what actually is a good PE ratio to look for then? Bad news is that it's not quite as straightforward as that. And a lot of this links to the fact that it is sector-based that we're talking about when we think, crucially, around the kind of relevance of PE ratios. Let's break this down a little bit further. So for stable, slow-growing companies, I'm talking about the likes of utilities that I mentioned earlier, the likes of banks, maybe energy as well. We would expect their PE ratios to be in the realm of around 10 to 15. Any higher than 20, and investors may start to ask questions about what's going on and why suddenly has their PE ratio shot up. For companies that are seen traditionally as growth companies, which have more recently been tech and AI-based ones, we'd expect their PE ratio to be that bit higher, 20, 30, maybe even 40 or 50. But we're going to start asking questions when they do get to those higher echelons, because it's like we really need to see where we think this growth is going. Of course, generally a PE ratio that's higher means that we expect it to really, really grow. But there's always a limit to how much we think something can grow. Now, it's worth noting at this point that I've spoken a bit about high PE ratios there, but some investors will seek out companies specifically with low PE ratios. This is because they're looking for what they believe to be undervalued companies, and they still believe that there is opportunity for growth in future. So don't be confused by the noise that might come out around that too. It's worth noting as well that companies that have no profits at all will have either low or no PE ratios. This, again, isn't necessarily a bad indicator. Often we anticipate that companies, particularly when starting out, don't have any sort of growth or earnings potential, particularly within that profit. Often when companies start out, they don't have any profit. Now, that's not unusual. It doesn't mean they haven't got growth potential. It just means that we have to adjust our expectations and therefore our reading of the PE ratio accordingly. So what these PE ratios really relate to is how much investors believe that the company has potential to grow in future. We've seen cycles of other companies having particularly high PE ratios. The dotcom bubble back in the early 2000s, electric vehicles back in the turn of the 2020-2021 period, and right now what we're seeing within AI stocks as well. So how can you use PE ratios in your investing? Well, unless you're an individual stock investor, PE ratios are likely to be one layer removed from your specific decisions. If you are a stock investor, you may be looking at PE ratios to understand the growth potential of a company, whether it's under or overvalued, whether it's a stable company, whether it's had any profits, and how it looks compared to various other peers, various other companies in a similar sector. For me, most beginners and long-term investors will opt for the likes of ETFs or indeed funds to balance out their risk, ensure that they've got a diversified portfolio, and avoid the admin and higher risk levels that can come with investing into singular stocks. But of course, you've got to make the decision that is right for you and your risk appetite as an investor. So back to the initial. If you've heard loads of people talking about that PE ratio, the reason why it's on the tip of everyone's tongues right now is because PE ratios are notably high within certain companies in the AI sector. This is causing people to worry a little bit that they are becoming more and more overvalued, and actually the anticipation of their future growth is outweighing what is actually possible. That's why people keep talking about it. Now, as with other situations in the stock market, none of us can predict the future. None of us know what is round the corner, and it may well be that those PE ratios are currently justified, and we'll see that growth really come into fruition over the next few years. But that's where a lot of the underlying worry around this AI bubble and a stock market bubble are coming from. It's all down to those little PE ratios that hopefully you have a little bit of a clearer understanding on now after today's video. So some key takeaways then from what we've just seen. The PE ratio is really looking at how much profit a company has made in relation to how much their share price is. There is no such thing as a good or bad PE ratio, but generally high means that we're expecting a company to grow, and generally low means that we have lower expectations of that. But this is all sector dependent. It will really hinge upon where that company sits and how they compare to other similar peers. Always try and compare like with like. And it's hitting the news and all sorts of topics of conversation right now because of the high PE ratios within the AI sector. So I'm intrigued. Do comment below with any other ratios, terms, or acronyms that you've heard of recently that you've scratched your head about a little bit and thought, not not too sure where that fits into this conversation, but I'll nod along. I'd love to break it down for you in another simple explainer. Thanks so much for joining and for watching this video. Do make sure you like and subscribe, and I'll see you all soon. Bye for now and take care.